Hi, I am Arvind Vinjamoori, Fundamental Research Analyst from Cargill Stockbroking Limited. Today I am here to speak on initiating coverage reports on KNR Constructions and HG Infra Engineering Limited. If you have any questions, you can reach out to me on the phone number and email ID mentioned on the website. Infrastructure is considered as the backbone of any economy for growth and development. We believe the current India government's focus on improving the infrastructure standards in a proper and adequate manner has provided many opportunities in the sector for various players. The trend in infrastructure sector has been characterized by high budgetary allocation, rising infrastructure deals, and increasing private sector participation. It is estimated that in India is in need of investments worth 50 trillion by FY22 to have a sustainable development in the country. Between FY9 and 19, the budgetary outlay for road transport and highways is increased at CAGR of 20.9%. The total investment in constructing national highways by both the government and private players was about 1.5 trillion, of which almost 1 trillion came from budgetary allocation, reinvestments of toll collections and borrowings by the NHAI. In FY19, the expenditure on national highways is likely to exceed 2 trillion, of which about 1 trillion will come from extra budgetary resource. The total investment in state roads between FY18 and 22 is expected to be around 4.48 trillion. Industry expects private participation in state roads projects to remain steady in the future as well. Through strong policy support and set of reforms, the government of India is working on reducing bottlenecks by pushing growth in the infrastructure sector. The trend can be observed in the road sector as well. Bharatmala Pariyojana is a new umbrella program for highway sectors that focuses on optimizing efficiency of freight and passenger movement across the country by bridging critical infrastructure gaps through effective interventions like development of economic corridors, inter-corridors, feeder routes, national corridor efficiency improvement, border and international connectivity roads, coastal and port connectivity routes, and greenfield expressways. A total of around 24,800 kilometers are being constructed in phase 1 of Bharatmala. In addition, phase 1 also includes 10,000 kilometers of balanced road works under NHDP, taking the total to 34,800 kilometers at an estimated cost of 5.35 lakh crores. The awarding activity has grown at a 47% CAGR during FY13 and 18. An aggregate of 51,000 kilometers of road projects were awarded during FY14 and 18, and another 20,000 kilometer target is set for FY20. This is about 25% more than the 17,055 kilometers awarded during FY18. Further, to add, an aggregate of 28,531 kilometers of highways have been built so far in the current NDA government's tenure. Construction of national highways has witnessed 22% CAGR growth during the first 4 years of current NDA regime. Construction of national highways has more than doubled to over 27 kilometers a day versus 12 kilometers per day, and the total investments in the sector has increased by 2.5 times. Hybrid annuity model, introduced in 2016, has become a preferred mode of awarding projects. HAM constituted 46% of total projects awarded in FY18. While we expect HAM to constitute a significant part of new awards going ahead, we believe it will be tough to maintain the momentum, especially considering the pace at which financial closures are done. HAM will improve the private participation and eliminates the traffic risk, and will provide cash flows to developers and ensure timely debt servicing for the banker. To raise equity from the market for its mature road assets, NHAI is considering organizing its road assets in the special purpose vehicles and monetizing structures like toll operator transfer and InvIT. While the YTD new road project award has been bleak due to challenges in achieving FCs for already awarded projects, we believe the authorities would start awarding new projects from FY20 onwards. So, HG Infra Engineering Limited. We initiate a covering both on HG Infra Engineering and KNR Constructions with a buy rating. So, coming to HG Infra Engineering Limited, it's a Rajasthan-based HG Infra Engineering Limited is primarily engaged in construction of infrastructure projects like highways, roads, and bridges. Over the years, the company has evolved into one of the leading road infrastructure development companies in India. Historically, HG Infra has witnessed a healthy order inflow, mirroring the current government's focus on improving the road infrastructure. Between FY15 and 18, order book has grown at 62.8% CAGR with an average order inflow of more than 17 billion per annum. The current order book stands at 4.25x to the FY18 revenue, coupled with anticipated order inflow of 73 billion in next 2 years is providing a healthy revenue outlook. Recently, HG Infra has won a HAM project in Haryana worth 580 crores in addition to the earlier HAM project with a construction cost of 606 crores. HG Infra also has added around 997 crores of EPC order to its kitty. Overall, sector may witness order awarding worth not less than 25 billion to 30 billion on EPC mode and another 10 million on HAM mode and the bidding is expected to happen by March. HG Infra expects another 1 billion to 1.5 billion order inflow this year from the expected order awards from the government. We expect future order book to grow at 28.8% CAGR during FY 18 and 20. While the focus on core strength, that is road and highway, continues, management is exploring other opportunities across the fields wherever the higher margin profitability margins exist. Although HG Infra enjoys a geographical advantage, management is focusing on looking for opportunities across the country. With its notable execution capacities, HG Infra has evolved from a subcontractor to main contractor and qualified to bid for big ticket projects independently. Aided by robust order book coupled with efficient execution skills, HG Infra revenue grew at an impeccable 60.8% CAGR between FY 15 and 18. We expect a revenue CAGR of 26.3% during FY 18-20 due to healthy execution rates with a negligible portion of slow-moving orders. We also expect EBITDA margin to expand by a marginal 70 basis to reach 15.6% by FY 20. During the period, we expect PAT to grow at 40.2% CAGR owing to robust execution levels, and PAT margin trend has been volatile in the past, and we expect the same to sustain at 7% levels by FY 20. Historically, working capital cycle has ranged between 35 to 75 days between FY 13 and 18. Despite scaled up operation, we expect working capital cycle to remain at a comfortable 50 to 60 days. HG Infra has invested around 4 billion in plant and equipment and has done recently hiring of 900 plus employees both at the senior and entry level. We expect HG Infra to witness healthy return ratios due to strong PAT growth, efficiently managed balance sheet, comfortable working capital days of 60 days, and healthy asset turnover ratio of 5x. Debt equity to ease of 0.7 from 1.1 during FY 18 due to 3 billion IPO. Gross debt also includes interest-free loan of 800 billion from the promoter, and we expect further reduction in debt levels going ahead. Management is of the view to reduce the debt levels further as the PAT grows. At current market price of 174, HG Infra is trading at 6.8 multiple to its FY 20 EPS. In view of robust order book growth and outstanding coupled with execution capacities, we are of the positivity of the company's future performance. However, excessive order book concentration and dependence on subcontracting remains a key things to watch for. We assign a conservative 9 multiple to FY 20 EPS, which is a 25% discount to its peer average for its core operations. We factor the HAM investments in Haryana at one book value and arrive at SOTP based target price of 240 with a buy rating. Coming to KNR Constructions, it's a Hyderabad-based KNR Construction is a multi-domain infrastructure project development company providing engineering, procurement, and construction services across various fast-growing sectors, namely roads and highways, irrigation, and urban water infrastructure management. During FY 14 and 18, KNR order book has witnessed a 16% CAGR growth in line with the government's road awards. KNR's average order inflow has been 30 billion during FY 16 and 18. KNR order book remained subdued between FY 11 and 15 when the National Highways awarded was averaged at 6,700 kilometers per annum. During FY 16 and 18, it witnessed an average awarding of 14,300 kilometers per annum, and the same trend may be observed in KNR's order book outstanding. Despite a tepid YTD performance, we expect the order awarding to pick up going forward, and KNR to witness an order inflow of 25 billion and 40 billion for FY 20 and 21 respectively. Larger part of irrigation projects are witnessed and execution levels. Thus, we expect most of the irrigation projects to be completed by FY 19 March, which adds to the revenue in FY 19 itself. Current order book outstanding of 555 billion, including the EPC opportunity of 39.8 billion from 4 HAM projects, provides a comfortable revenue visibility as the order book stands at 2.9 multiple to the FY 18 revenue. Revenue to grow at 15.5% CAGR during FY 18 to 20, owing to healthy execution and robust order book outstanding. KNR has a consistent margin profile of around 15% EBITDA margin, ROE, ROC levels at more than 15%. We expect the trend to continue in future as well. Historically, KNR has always maintained a strong balance sheet with debt equity ratio less than 0.2 levels. Standalone liability stands at 2.3 billion, which includes a promoter loan of 2.1 billion. KNR has always maintained a lean working capital cycle, especially a strong control on receivables of 20 days as of Q3 FY 19. KNR also witnessed a consistent improvement in ATR from FY 14 to reach 5.8 multiple in FY 18 versus 2.4x in FY 14. Going forward, we expect the ATR to stabilize at around 5% level, 5 multiples. EBITDA during FY 14 and 18 witnessed a 32% CAGR owing to higher execution levels. Going ahead, we expect KNR to maintain EBITDA margins of 16% levels. During the period, PAT margin, we expect the PAT margin to normalize to the effect of 80A of IT Act and KNR to be subjected to full tax from FY 21 onwards. We expect the PAT margin to reach remain at 9 to 10% levels for FY19 and 20. Considering the relatively lower capital outlay towards HAM projects, we believe in the return ratios to remain in elevated levels. KNR has always maintained a lean working capital cycle, especially a strong control on the receivables of 20 days. As of Q3 FY19, we expect the working capital days to remain at a healthy levels of 40 days. And KNR is in the process of monetizing its assets in various projects as a part of our strategy. KNR entered into a share purchase agreement with Cube Investments and Infrastructure for 3 of its SPVs at an expected return of 1.8 multiple to the expected equity infusion of 145.35 crores. The transaction is contemplated to be completed in 2 stages, subject to the approvals of changes at the time of COD. At current market price of 203, KNR Construction standalone EPC business is trading 11.6 multiple to FY20 EPS. We value the EPS business at 12 multiple to FY20 EPS to arrive at the value of 209 per share. We also value the BOT at 1 book value of equity invested, that's 20 rupees per share. We also value the HAM opportunity at 1 multiple of BV of the expected equity investments in the next 3 years, valuing at 25 per share, thus arriving at the value of 260 rupees based on a SOTP valuation.